Okay. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. Thanks for the opportunity, Prof. Sembol. First of all, allow me to speak not in Bahasa. Today, I'm going to share some thoughts and discuss some aspect of the petroleum investment analysis as it's applied to all and oil and gas project. So these are all intimately interconnected. And anything that we do in support of decision-making process under the risk and uncertainty. So what is a digestion? The formal definition of digestion would be a choice between two or more alternatives, and it's also involve irreversible allocation of resources. Perhaps in American English, sometimes say that this is my only alternative and this is wrong. Based on this definition, if we have only one alternative, it's not decision. If we are having two or more alternative, then that's a decision situation. So the one requirement would have been two or more alternative. The other requirement would have been the irreversible allocation of resources. The second requirement bit tricky, and perhaps we can discuss it by simple example. Let's say if I want to buy a new car, here I want to buy Rolls Royce. Directly, I go to a dealership and see what happens there. The dealer show you the car and you can see the car, you can touch the steering wheel, but so far you haven't been committed to this diffusion at any point in time. We we can go on our financial situation would have been the same as before. We can say that this car is not for me and there are no commitments, but once you commit to buy this car, once you pay for the car and sign the contract, then it's an irreversible situation. What I mean by irreversible is let's assume that you buy a car, you sign the contract and pay for the account, and 5 minutes later we decided that, well, this is not good car for me. I want to return back. So you go back to the dealership and you say, well, this car is not for me. I buried 5 minutes ago. The answer is usually like this. That a second-hand car in excellent condition and where we can buy it from you, but not in the price of new car. So by this situation, it's not reversible. You can go back to your previous financial situation. What I mean by irreversible allocation of resources, once you pay for the car, then it's reversible. So that's when we have actually made a decision and to do some in practice. Um, do an analysis of why we do engineering to the larger context. To the larger some extent, we make good decision. There is no other reason to do analysis. It's not fun. It's not a formality. It's only serve the purpose of making good decision. So in the next following slides, let's take a look at simple decisions, perhaps a personal decision we have done before jump into the case in detail. In general, they are almost the same in economic decision analysis. The course does ensure basically we are talking about translating the risk, translating money, translating enduring discipline into money term. The estimate certain risk of project, we have view on a project cash flow, and based on this information, we come up with a relative ranking of the project. And finally, we assess the effect of the project and the company position. In this environment of uncertainty and randomness, how should we make a decision? Well, there is no solution that solves all the problem. The best we can do is to make good decision. In order to make good decision, we need to see if the story that we are talking about of the investment makes sense. Then we need to model the key decision and uncertainty within the investment. Further, we need to do some forecasting. We need to do some reassessment, and we need to make decision based everything unbiased analysis. So the only thing that we can do, so that's the only thing that we can do. We can have when we have uncertainty and unpredictability. For the certain case, for example, in the oil and gas industry, we need to know why we are investing on it, what we are looking for, what is our objective in doing all this investment in any corporation. The objective is to make a company growing, as we can translate it into perhaps other objective. For example, increasing the size of our firm, as we can increasing the stock price of the company. But these are sort of complex goals. If we are thinking about making decision in exploration context, how should we make a decision based on the success? Should we make decision based on technical success, geological success, or the amount of oil that is going to be produced, or some other measurement? And here we are trying to dig more some of the measurement in the decision-making process. Should be expected to value that we will get on average based on the uncertainties and the decision that we make. If any these other objectives are achieved, then it just actually means that you are making your money grow. So you just make things simple for us. The objective of any investment or any decision in this industry would define as creating value. So with this, which is a very important finding, we can analyze our investment and also our decision quality. In very simple sense, we need to always see if the benefit outweighs the cost. If that's the case, then we are creating value. So in any decision, if the expected benefit outweighs of the cost, then we create value. We are talking about expected just because we are acknowledging the fact that benefit could be uncertain in the future. And because we don't know about the future, they are going to be uncertain about the cost. Again, they have future element about the cost itself. We don't know about all the cost beforehand. So even the cost could be uncertain. So the expected benefit need to be outweighing the expected cost. So as an uncertain one, of we need to define as a factor in decision analysis scope of work. Again, let's look at the scenario where we discover some oil. We could think of it in money term. So that, well, on to the dimension, we have the horizontal dimension as a time and vertical dimension as the amount of money that we receive or pay. So right after discovery, we have to pay more of the development cost. We know oil is there in the subsurface, but it's not readily available. We develop the oil field to make it available and produce it and send it to the market. So this means that few years sometime, for a decade, we will have negative cash flow. Then after this time of preparation, do construction, facility development, we will get production profile. Okay. It will start and it will act ramp up, reach approaching the peak of the production, and it will gradually decline. That's the pattern we observe in many of the conventional model. So we produce oil, we sell oil and gas into the market, and we get the revenue. The revenue is just production time expected price. So here's showing the expected price in order to operate this asset. We need to pay operating costs called OPEX, and also we need to pay tax to the government, pay the variable cost and things like that. So this is simplified picture. All of us, the picture of all the cash flow that we will get if we make discovery, but then we only need one number. What is the value all of this? We simplify this again into one number called with NPV, or net present value. Net present value is the sum of all discounted cash flow. We get the cash flow each year and we subtract the negative cash flow from the positive one. Then we get this net cash flow. We discount them or The year that they account for the result is one number. Here I'm showing it with a green circle, and that number represent the holistic picture. This cash flow we can use for our digestion tree. The introduction show a lot of simplification in the analysis. The simplification are necessary because otherwise the details would have drawn us to make some other complexity, but I still need to reflect on the key aspect of valuation. So this is the typical of market uncertainty in oil and gas project, for example. They are not all about subsurface. They're also an economic aspect of this project because whatever we do, we are at the end of the day running the business and supposed to sell the produce oil or gas. And here's the graph. We can see change in the oil price over the past 30 days and 30 years. We have shown the amount both the money of the day and today's money. You can see it's an uncertain path. It has been unpredictable. Well, it didn't stop the company. It didn't stop some companies and some institution to predict the oil price. Here I'm showing the historical price forecast by energy department, which is part of the government. And we can see that in the year 2000, for example, the prediction was the oil price will stay at 20 and they will remain there for the remaining the next 10 years, but it didn't happen. Oil price jumped, they went up, then they revised the production. And this graph show they never got the prediction right, the oil price. And oil price will always unpredictable. The prediction will always incorrect. So the fact that we have uncertainty in this market just prove any prediction unreliable. So the message is that if all forecasts are wrong, there will be always surprise because of the uncertainty. So far, we discussed some surface and about the subsurface uncertainty. These are the least two things that we could imagine that affect the value of the energy project, including oil and gas exploration. So how should we make a decision? So what are the different aspects of the uncertainty? Perhaps we can look at the subsurface thing. On the right-hand side, as we can see map of the Norwegian continental shelf, of course, here, the country Norway and Sweden. We can gather information from this website, actually, as written in the bottom. In Norway, everything is publicly available, and we can visit this website as shown in the button to access the information. I have used that database, and then we can say that from time 1966, the dawn of oil and gas industry up to 2018, there were almost 2,000 exploration wells drilled in this region. See, this region is quite busy. And out of this, 1,951 exploration wells, is around 1,248 wildcat that were drilled into the formation in the hope getting oil. So out of this wildcat, there were only 523 something discoveries. So what does it mean? It just means that almost third brought discoveries, and the other two-thirds of the wells that had been drilled ended in nothing. In the oil and gas jargon, they call dry hole. So when it's dry hole, it just means that multi-billion-dollar wells out that you spend some time in drilling, all the money is down the drain tube, and you have found nothing. It's like all your debt has not paid off. In that case, we have lost in one lifetime. So in this situation, we will discover. So in this situation, we will discover large amount of oil and gas. Those large amount will make a future of your company. But most of the time, here the data show that you will get the majority of the well end up being dry hole. That contribute the benefit and cost. So perhaps on the cost side, we have the tax that we need to pay the government. We need to pay the operating cost, the staff first. all of we need to have capital cost that's called capex. It's required to make the project happens and the project execute to be executed for the funding. And the left hand side on the benefit, we have, of course, the revenue that we get by selling the produced hydrocarbon. We may charge tariff to the third parties, or we may get tax benefit like depreciation. But is it all the face of uncertainty? Flexibility also there, and other less tangible benefit, for example, value of flexibility and value of information on how much should we invest in information that give benefit more than its cost. How much should the value be? And how should we make decision about the flexibility? How much flexibility is valuable? Flexibility, these are a bit more difficult question compared to the, for example, value of revenues. So in order to do in modern economic analysis, we need to be able perhaps to assign the value to value flexibility and value of information. So yeah, let's take a look drilling case, as I mentioned earlier, in the context of decision process under uncertainty analysis. The slide show decision tree, we would drill or walk away. If we drill, then there is a chance of success. And if the ball is dry, with the probability 1 minus chance of success, we will have to pay the cost of training. If we find the oil, we get net reward, which later on we will discuss that this net reward in the net present value. All of things, all the cash flow that will happen after the discovery. So this is a simple analytical so this is a simple analytical model to help us make decision. If the expected benefit of drilling outweigh the cost, then we will drill, otherwise we will drop out. Practically, the decision tree is diagram composed of nodes and branch. See? There are three types of nodes: choice node, chance node, and terminal node. Choice node represent a decision based on the rules, often simply reduced to select the path with the maximum expected gain or minimum expected loss. Chance of node represent the uncertain event. Chance nodes are usually depicted as finite set of mutually exclusive alternatives, each having prescribed probability of occurrence. Alternatively, a chance node could be represented by probability distribution. A terminal node represents the end of sequence branch through chance and choice node. Typically, a terminal node is assigned a value representing the last step from choice of or chance. So what is a good decision model? Well, perhaps we could introduce a simple decision tree model here, but before that, we need to consider the fact that the most exploration wells are plugged and abandoned after they reach their objective. They reach their objective of gather information. So in a way, after they reach of formation and mean for the information is gathered, most exploration are plugged and abandoned. That's their fate. So in a very exploration drilling, it's about investing in information. How do we evaluate the information? Well, we usually use a decision tree model like this to evaluate the information that we come from an exploration well. And these decision tree models, we are saying that we have decision, we show decision by square node, we could drill or we could walk away from this opportunity. We walk away, the outcome is zero. If we drill, there is uncertainty about the success or failure. We are not sure if the hydrocarbon exists in the formation. With some probability, we will be successful. If we are successful, we will get reward. That's the NPV of success. If we are not successful, then we will have to pay cost of drilling, which I call it here in the NPV of failure. So what is the NPV of success? Maybe we could dig deeper into the element of NPV success. As I mentioned on the first slide, where the decision process under risk and uncertainty. So what do we mean with the risk uncertainty? Simple definition for the risk. It can refer to the probability of gain or the probability of loss, and practically PS refer to the probability of gain is expressed as 1/4 or 0.25, while PF are referring to the probability of loss is equal with 1 minus PS. On previous slide, we have seen some models of the decision tree analysis where the EV expected value are defined multiply of PS and again minus 1 of PS of the loss. Uncertainty are what we don't know, something that we don't know because of lack information about the outcome, factor that influence them, and refer to the range of possible outcome and given success and generally express range of value are variable. The wider of the range and the greater uncertainty. So here let's consider two well examples. Let's assume that we have identified two exploration prospects. We call them alpha and beta, and we have calculated net reward, net cost of drilling, chance of success. We can use the older analytical model. We could see the target just to make life easier for us as we calculated the element that we need to include in the decision tree. So for prospect alpha in the top, NPV success is $35 million, chance of success 35. Compared with the beta prospect, we have NPV success only 15 million and cost of drilling 20 million. But the chance of success is higher, almost half 49. So using the analysis that we discussed earlier, I could put this number into the JSON tree and calculated the expected value coming from this prospect, then we can decide if we should read them or not. In certain degree of extension, we had a sophisticated model that accommodate a problem consisting of two wells, but we could think of also extension, some extension to more wells, perhaps if we could consider a common in the area originally, we had alpha and beta and geologically correlation between them. We could imagine that this area we have identified other drilling candidate. So number of prospect is there. If we have 5 drilling candidates, the number of correlation increased to pairwise correlation increase to 10, but the number of overall, all the conditional probabilities will actually increase to the 100, and including 100 of conditional probabilities into larger decision tree and perhaps unpractical. So the best course of action in each case for the prospect alpha, I have decision to make. If we drill, we may find the oil with 35 chance, or I may end up with dry hole 65% chance of success. In the case of oil, net reward is about $60 million. In the case of dry hole, the net reward minus $35. So we can do the same thing. I can make the same decision for the beta prospect, and there the net reward is $15 million. We will get with the chance 45%. Otherwise, I may end up with dry hole with chance 51%. I would need to pay the cost of drilling. So what would economic reasoning tell us do here? The expected value of drilling on each case is negative. It just means that comparing the expected value of drilling to the expected value of walking away from zero is better than negative number. So the solution would have been to walk away from these two prospects. This might be sort of this disappointing result. We have identified in these two well. The economic model tells us leave them or discard them. Well, we may discuss further this in the larger context by saying that, well, these two well or these two prospects were identified in neighborhood. This chain of success are mainly interrelated. We have discussed earlier. Here, simply, we could say that in order for well to have hydrocarbon on it, need to have a cap rock, hydrocarbon charge, reservoir arch. If all three elements are in place, then we will encounter hydrocarbon in some location. One of these elements may be missing, so we may end up with dry hole. The information could be used to make more informed decision on another one. So the chance of success will be updated based on the information we get on one the other location. How can we show this? Well, we can show it in this table using joint probability. The number in the table blue, these are joint probabilities event that could happen, the outcome that could happen based on this table. For example, 20 and 23, 20 and 23 chance for the joint event. The alpha is success, delta is also success. Here 26 chance for the alpha being dry and beta being success. So how can I include added information into my analysis? Remember that my previous analysis only used the marginal probabilities. The one in greens were included in the tree. Now I have more information in terms of joint probability. So how can I include this in the larger? The tree is a bit larger. This first set of action that I could take would be to be drill alpha to really better or walk away. If I drill any of this well, the chance of success would be as I had before, 35 for alpha and 49 for the beta. But then based on the outcome of each of this well, I could decide to drill the other row. So if I had started by drilling alpha, after the outcome is revealed, I could decide the drill the well beta, and the chance of successful beta in that case would be conditional on the outcome that I have already observed. So this probability and the outcome will be updated. So we can see the second set of probability are conditional probability, and they were calculated based on the joint probability that we had in the previous slide. Decision making is a bit more complex because we have larger decision tree, but anyway, it's still simple. Best course of action would have been to drill data. If it is oil, then drill alpha. If the beta is dry hole, then we need to stop. We need to stop to drop, not to drill the other well. Following this strategy, give us an expected value 2 million. It's positive, remember, that if we consider this prospect in isolation, the expected value would have been negative. Now, considering the added information, the expected value is positive. It just means that it's readable. We recommend drilling based on this course of action for sure. So only if we drill beta first, drill alpha if it is successful, walk away if it is dry hole. Only this strategy result in a positive net present value. Of course, it is an expected net present value. So we calculated the value of information in a way that added information compare to what we had in the beginning. It just lead us better decision and positive value for this project. So the solution to the problem should use dynamic programming, which we don't discuss today. And I just wanted to show you that there are solutions for these things. Another extension of this model would have been to consider oil price uncertainty. And what I mean by oil price uncertainty is that, well, let's assume we have all our prospect pipe drilling candidates here. We consider drilling them. Also, please mention that, well, there are time required to drill the well, perhaps few months. There are also some time required to interpret the result, perhaps a few months. And if we consider on temporal basis in the beginning, we have 5 drilling candidates to drill. Okay. We could think of it in the time of dimension. The first period we determine the first row, then on the second period we have 4 trillion candidates. to make better decision about, and then we identify the best course of action, and then the third period we have three alternative and so on. So we continue to determine for the best option, the course of action as we move into this project. But then we also need to know that during this time, the oil price change. The economic of this exploration, of course, is very sensitive to this oil price. Or if you are thinking of in practice pipe drilling candidate, and usually for few months required to derive the well, and few months required to do some interpretation, and the FAB would have been drilled almost 1 year apart. So for 5 years drilling campaign, we are looking at 5 well, and during these 5 years, we will have lots of fluctuation in the lower price. The oil price will affect the economics or the decision, and this these are some extension that I just wanted to tell you about, and we discussed them in more detail within the course of research. End of this presentation with the message, the mathematician Raymond Dyson, who was also a physicist, he said that mathematicians are either bird or frog, and of course, he mean no disrespect by bird to fly high, and says his viewer. And by frog, he means those mathematicians that consider a specific problems in detailed drugs, usually the flowers that grow nearby. So these are too few of mathematical aspect. I believe the same apply to the energy industry. Some are focusing on the problems in detail. Some other fly high and consider the holistic picture in the energy industry. So of course, we need both of them, and sometimes we need to be both frogs and very perhaps the bird frog to switch between views to see the details and also to see the view in different perspective. So in summary, there are things that we don't consider because they are less tangible in the energy project. All of them are about the future and undertake them for the hope of creating the value in future. Everything about the future is uncertain. We had subsurface and surface, which are basically our lack of knowledge. So uncertainty has to pace at least. There are technical uncertainty like the oil in place, and there is also market uncertainty, which more likely price of oil in the future. So these are all uncertain world, the art of decision making. To intimately combine the technical and market uncertainty. We call it art because it's more than technical science valuation decision making. It has an artistic aspect on how to combine these two aspects, technical and market. So finally, our analysis for decision making are there. No other way. Either we support making decision or we make decision ourselves. So these are all these analysis. So these are all these analysis. Thank you.